Welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I'm Sumaira Abdi. Continuing with our focus on corporate campuses, today we're in Bangalore at the headquarters of Sobha Developers. And the good thing about the changing corporate scenario is that a lot of companies are now taking initiatives for their employees. Sobha Developers is one among them. So let's hear out Mr. J.C. Sharma, Vice Chairman and Managing Director.
What Sobha Developer does is the following. Primarily, if I recollect at the time of our IPO, we reserved a quota of 10% of the total equity for them, where we gave incentives and benefits to up to 50,000 rupees per employee to participate in our IPO, where 56 crore rupees worth of shares were reserved for them. Number two, as and when the budget which comes in the month of February or March, we ensure that all our employees, they are communicated with what kind of savings and what kind of instruments they are having to ensure that they can invest wisely on those schemes and save. As far as buying homes, because we are in the real estate, we ensure that the employees are given the maximum possible discounts to buy a Sobha home.
All right, so you heard Mr. Sharma there with the kind of initiatives that Sobha Developers have taken for their employees and their investment needs, but a lot of them have gathered here also today, and to advise them, we have Ambrish Baliga and Uday Dhoot. But before we open the floor to the audience, we did a straw poll of sorts, with the audience who've gathered here, and this is what we found. We found, Ambrish, that almost 50% of the people who've gathered here said that they're somewhat comfortable with, say, stock markets or mutual funds, but an equal number said that they're not at all comfortable, and it was a very minuscule 8% who said that they're very comfortable. Okay. And of the people, of the investing surplus that they have, most of the money is actually still finding its way into that traditional bank FD, and there are very few people, actually a very, very small 4% is investing in gold ETFs, which contrasts with, a whole lot of the people we've interviewed so far who are now beginning to favor gold ETFs. So that's something that is unique to this group here. And also insurance investments is about 16% of people are favoring insurance investments. So that's something also I want to ask you later about, this confusion between insurance as an investment option and how it should be, delinked. Also another thing is that currently about 44% of people are investing under 1 lakh, which ideally qualifies only as tax saving. And the active wealth creation of between 1 to 3 lakh surplus annually is done by about 40%, and the real aggressive investors are about 8%. So that's something that we look to be changing. But Ambrish, I want to begin with you that now if you look at India as a whole, at least to the untrained mind, things do look to be on the mend. There is some amount of liquidity that's also coming in, maybe because of global sources. Right. Do you see the return of retail investors, therefore, to the equity markets?
I do see a return of retail investors, but then don't expect them to come back in droves tomorrow, just because things have changed, announcements have been made, and because of that, they'll not come back overnight. I think after this 4-year of bearish sort of a state which we have been in, I think it'll take a while for these retail investors to come back, unless they see that the markets are holding up at those higher levels. People around are making money. I don't expect them to come back so soon, but hopefully, if things look better, I suppose in the next 4 to 6 months, you should see the retail investors back in the market.
I want to ask you this, that if retail investors are not participating in the equity markets, surely there's still investments that are being done. So a lot of it would be finding its way into mutual funds or other products. Can you take us through, maybe the other gamut of products that are available besides just the very obvious choices that people are making?
See, if you look at any individual investor in India, typically it starts with tax saving. And when you're saying tax saving, so basically the traditional ways are you first go in for insurance, you go for PPF, and so on and so forth. But most of the people are basically stuck in insurance. There's a lot of money actually which goes in insurance. The recent RBI report, if you would have seen them, very clearly said in the last few years, investor interest is more towards physical assets by way of real estate, by way of gold, and not necessarily towards financial assets. And this is a very typical thing of a retail investor, because retail investors typically go in when the party is kind of getting over and then sort of get stuck and then move along. But I think what people need to do to begin with is you need to know what you want, and that's where your whole thing should begin in terms of identifying what is the right product for you.
That's true actually, because a lot of the investors that we've been meeting, they all say that I like to see where my money has gone. So I can see my house, I can see my gold, I can see my property. So I like that. I don't like the ambiguity of paper money, so to say. But let's see what our audience over here wants to know. Let's open the floor. Who'd like to ask the first question?
In this market where the customers are following the old traditional method of investment and seeing gold physically, and that ETF scheme is not more popular, it is not being brought in through these investors, do you advise still that ETS is the best form, or to keep it as in gold?
In India, gold has a lot of traditional value apart from all the investment value that we have been recently talking about. Indians have been investing in gold for ages. But when we talk from a purely investment perspective, what are we looking at gold? Gold for us is nothing but like an insurance for your portfolio. When will gold do well is what typically is asked for. When gold will do well when everything else around you is not doing so well. So think of it gold, because gold otherwise gives you no regular returns. There is no interest coming from gold, there is no dividend coming from gold. So gold is purely a hedge against uncertainty. Now look at traditional investments. So we have all been buying physical gold. Now if you look at today's investments, you can buy gold through something called ETF, which is nothing but an exchange traded fund. Typically a unit of that gold ETF approximates to around 1 gram of gold, not exactly. That is something that you can buy. So you can buy like 3,000 rupees, which is approximately 1 unit today. You can buy, if you are not having that demat and trading account, you can buy gold through mutual funds also. There's something called a gold savings fund. Typically these gold savings fund in turn invest in these gold ETFs. So you're actually getting exposure to gold from there. The good part about this gold is that all of this gold is backed by actual gold in banks. So it's a fairly safe way of investing in gold. The other advantage of having gold by this way is that one, the whole jewelry cost and is not there. Typically a lot of people go and buy gold from the bank. We have seen buying gold from the bank can be very, very expensive. So buying it from the financial markets could be much cheaper for you. Tax wise also it is much more efficient. If you sell these gold after 12 months, you typically pay long-term capital gains tax. Otherwise, if it is physical gold, you have to hold it for a period of 3 years, and then only it becomes a long-term gain. So there are both these advantages that you have, both from accessibility, tax efficiency, as well as the security of having this gold for you.
Yeah, and if you own jewelry, I know nobody ever wants to sell it. So this at least takes the emotions out of selling it when you need to. All right, who else has a question?
Before that crisis happened, that recession, one of the leading banks, who's awarded many times on this private equity, I invested in their portfolio investment. So 2 years when it was maturing I thought it will keep on rising or something. What the amount ended was from 12 lakhs to 5 lakhs. So it was a very disastrous kind of thing. So what is the timing that we do in equities, and what we should be careful? If that bank which is known for investment failed, I think I would have better come out of it myself rather than going to that bank for investing.
And I want to, Amrish, just add a little bit to what Mr. Raman has said, is that a lot of people, when they're investing, many times we tend to disregard the news flow that's coming in with regard, and with equity in particular. So how can someone, a retail investor, read the news flow that's coming in and associate it with the equity that they own currently?
No, I mean, one thing which is normally said in equity markets, buy low, sell high, which also means that you need to time the market. But timing the market, I think, is next to impossible. I don't think anyone can really time the market and buy at the right time and sell at the right time. You're doing somewhere in between. So for someone like you, who cannot invest too much of time, not money, but invest enough of time on the stock markets, the best way ahead is systematic investment plan. This actually helps you average out the ups and downs in the market. So if, for example, if someone had done a SIP over say 4 or 5 years, it actually balances out. And as far as the news flows are concerned, generally I think if you don't have a large portfolio, it is much easier for you to keep tab on your investments. I mean, if you have a 50 stock portfolio, it's very difficult to keep a tab on news items and news flows on all those 50 stocks. And if you can't keep a tab on your stocks, you won't really know as to when could be a good time for you to exit. I'm not saying the right time, but a good time for you to exit, or maybe average out more. So typically, equity portfolio, I don't think you should have more than 15, 20 stocks, surely not more than 30, so that you can keep a tab on the news flows and act based on that.
Yeah, and as in the case of health, you take a second or third opinion from a doctor. So if you think that the advice isn't sufficient, I'm sure you're well within your rights because you've worked hard for that money. So let's take a very quick break on that note. We'll be back in just a bit. Do keep watching Informed Investor. Welcome back. You're watching Informed Investor. We're at the headquarters of Sobha Developers in Bangalore this weekend, and a lot of employees have gathered here and a lot of questions are waiting to be asked. Amrish Baliga and Uday Dutta here to answer them, so let's get to it right away. Ma'am, you have a question. Go ahead.
Yeah. How is SIP better than lump sum investment?
SIP averages out your investment either on the way up or way down, because when you're investing in a particular stock or a mutual fund, your expectation every time is that it will move up and you'll get profits, but that need not be the case. You could have the value or the stock price coming down. So in that case, you're straight away losing out if you have invested whatever you wanted to invest at one shot. So by investing in installments, you are able to average on the way down. And at the same time, if the stock moves up, you are also able to average on the way up. And anyway, your initial investment is making money, plus your future investments also continue making money because the stock is moving up.
And like Amrish had mentioned that even the best of investors find it difficult to time the market. So this way you get the best of both worlds. So you have a question also.
Just wanted to know, I'll tell you that I have an investment of around 87,000 annually in insurance and around say 25,000 in extra bonds, in infrastructure bond and others. And still I'm left with around 5 lakhs every year to invest. So if you can just give me a thumb rule in terms of the timing and maybe the apportionment also of the this savings into various investments, so that I can take care of my future plans, which may be marriage, taking care of my aging parents and like that.
Now, very important thing for you to understand is that before I can tell you where the assets should be apportioned, is that how and when do you need the money? When you say, okay, medical emergencies for my aging parents, so the kind of investment that you need there can be available to you readily on like a 2 days notice, in a 1 day notice, because emergencies don't come telling that okay we are coming, right? So that is what you need there. So figure out, okay, I would like to keep aside a 2 lakh kitty at any point in time available to me. So for that investment, do something which is very safe, very liquid, not locked in long-term products. Then you're talking about my marriage. So let's say if your marriage is, I'm not sure, 5 years away, 1 year away, 6 months away, right? So you need to figure that out. First, if I'm planning for my wedding, sorry, I'm already married, but if something is 10 years from now, then I can plan my investments accordingly. But if I'm planning to get married 2 years from now, then there is very little risk that I would like to take, right? Because you would not want to decide which hotel your marriage happens depending on your portfolio size. You would like to do what you really wanted to do all your life, right? So think through what is your time period for these investments, when do you really need this money, and then accordingly spread it. SIPs is a great way to building your assets. SIP is just a mode of investing. SIP is not about equity investments. SIP is not about anything. SIP is just about bringing in the discipline in you. They say that you don't see it, you don't spend it. So let's say if the salary comes in on 31st, make sure on 1st a good chunk of what you want to save gets stepped aside out of your bank account into your investments. These can be in liquid funds, in debt funds, in RDs. Everything is just an SIP. It's just a systematic investment plan. So put it aside and then sort of plan depending on your time, when you actually need the money, what kind of growth do you need from that money, and so on and so forth.
All right. So let's get some more questions in. You have a question, sir.
how do you choose the right equity mutual fund? Because currently there are a plethora of equity mutual funds to choose from. Is it advisable to diversify between the equity mutual funds? And should you stop investing in a equity mutual fund when a fund manager leaves?
When a fund manager leaves, yes, I think that's a very important criteria, because if you look back and see the performance of a number of mutual funds, which I wouldn't like to name, but then when the fund manager has left, the performance changes drastically. So one of the important criteria clearly is the past performance with that fund manager, because a fund manager makes a lot of difference. At the same time, I would suggest that you should look at more of a diversified mutual fund than sector specific or some theme based mutual fund, because a theme just lasts for possibly a couple of years, doesn't really last beyond that. So look at a diversified fund generally.
And I want to just ask also the converse of that question.
Right.
Is it what happens when a fund manager, say, violates the mandate of that fund? What does a person do then? Is it a good idea then to sort of move away from that fund?
Yeah, I mean, if if the fund manager is violating the basic principles or based on which you had invested, it's possible that it could be good for the fund, but then ethically it is wrong. And in future, again, if he does something of that sort, it could be detrimental for your investment. So in such cases, I think you should be moving out.
On that note, let's take a very quick break. We'll be back in just a moment. Stay with us. Welcome back here watching Informed Investor. We've been crisscrossing the country, and this week we find ourselves in Bangalore at the headquarters of Sobha Developers, and we have a lot of employees who've gathered here who'd like to ask questions. So let's get to it right away. You have a question, sir.
My question is just pertaining to the beginners, let's say at the age of 25 to 30, who's just starting the career and earning about 5 to 6 lakhs. And say monthly, the rental and the necessary needs, all those things, after spending all together, the balance left of, let's say, the 2 lakhs or 3 lakhs kind of a thing, who may not be invested in the properties or other things, how to allocate these fund kind of a things.
So two good things going. One is that it's a clean slate. Second is that the goal at least has been identified, which is property 5 years down the line, sir.
Okay, so a 25-year-old, I'll start typically, since we are at Sobha Developers, is that the first thing that you do for a good building is build a very strong foundation, right? So, so for an individual who's starting afresh, who's young, I would say take in your insurance. Possibly you do not have dependents today, but you'll have dependents 3 years, 5 years down the line. The younger you are, the cheaper is insurance. For a 25-year-old, a 50 lakh rupees cover would cost you 500 rupees a month. So possibly take some amount of insurance for yourself covering your life, and then go about the SIP route of investment. Typically you're looking at investments 5 years down the line. So it's possibly a good time to have some amount of equity exposure along with some amount of debt exposure also. The only thing apart from that one goal that you have 5 years down the line is that build yourself some small little corpus that is like a emergency corpus. So you have like a 2-3 months earnings or expenses kind of a corpus put aside just in case there's any emergency. So possibly do that, put in your monthly investments. That is the best way to actually create wealth.
Yeah, and because you're starting out, so your risk appetite is much higher. So perhaps a greater allocation to higher risk assets for now, and then try and change the allocation later. All right, we have time for one final question. Go ahead, sir. Do the retail investors actually make money in the capital markets? Because over a period of time, the present idea will become outdated, say after 2 to 3 years. Like the pension plans were the in thing some 3 years back. Now they are like, nobody wants to touch them. Do you think that we should, as a retail investor, are we fed with more information than what we can actually digest? Or should we stick to the conventional forms of investment like real estate, gold? I don't know. I'm confused.
Retail investor, I would say, is just like a consumer. You want to get fooled, you can get fooled. I mean, people go out and buy fairness creams thinking that they'll become fair overnight. So it is something similar. So that's the reason I'm saying that any investor, retail or otherwise, should clearly have their objectives very clear. And once you have those objectives clear, have discipline. If you're a long-term investor, be a long-term investor. But generally what happens is, a retail investor comes in for the first time, makes money in the next, couple of months, the first couple of months, becomes more aggressive, then he wants to become a trader, then he starts working on tips which he keeps getting from the media and other places, and then finally he loses. This is generally what happens to most of the retail investors. But if you maintain your discipline, which is very few of them maintain discipline. If you maintain discipline, you'll surely make money in the longer term. But again, I'm saying one need not be making money only as an investor. I've seen retail investors as traders making money. But then they are traders and they have discipline. They don't become investors. As a trader, you need to keep stop losses. If you don't keep stop losses, you become an investor.
All right, so no asset class is inherently evil or monstrous, if you keep your eyes and ears open. But anyway, you've been a lovely audience. Thank you so much for having us over. Thank you so much, Ambrish and Uday, for sparing the time to be here today. On that note, we need to wrap up now because we're absolutely out of time. But do keep sending us your questions and comments. And if you'd like to invite us to your corporate campus, you can also write into us. Here's where we'll take your leave, but we'll see you next weekend. Bye-bye.